Thank you so much for coming to check out another episode of the Stash Cast, where we have interesting conversations with interesting people focused on the world of commercial real estate and prop tech. The Stash Cast is brought to you by Nedl. What if you could use data and analytics to predict real estate transactions? You can with Nedl. Check it out at Nedl, Nedl.us to learn more. All right. Today I have the famous, the one and only Ash Patel with us. Ash is the managing partner of Invest Beyond Multifamily. And I'm super excited to talk to you today. Ash, thank you for
Hey, Stash, great to be here, man. Thanks for the invite.
awesome. So you and I met many years ago, but you weren't really in multifamily, and I guess I gave you the cold shoulder. It was not intentional. But you've been able to build quite an enterprise for yourself investing beyond multifamily. So I guess why don't you, if you could, can you give us I guess, an overview of who you are and what you do?
Yeah, I was almost a multifamily person, but I got very lucky. My very first property was a mixed use building. So I saw the residential side of commercial or real estate, and I saw the commercial side, right? That first building, man, I had college kids destroying my apartments, and I had a commercial tenant who remodeled his own bathroom, put $30,000 of his own money into my building to fix his HVAC. So the moment he did that, I had an epiphany. I'm like, why would anybody invest in residential when all the tenants do is add wear and tear? You have turnover just about every year. Commercial tenants sign long-term leases and they improve the property on their time and their dime. So that was a game changer for me. That's when I became a full-time commercial real estate investor. That was almost 15 years ago.
That's amazing. What were you doing before you got into real estate? And I guess what motivated you to get into real estate?
Oh, I had some immigrant parents that made me go into IT as a major in college, and I had a 15-year IT career. Hated going to work every day, always had side hustles, and it wasn't until I found commercial real estate that I knew that was my calling. Absolutely fell in love with it.
Awesome. Let's play the fear game a little bit of like, I know apartments, and the thing that I guess resonates with apartment investors is that you can't sleep online. So maybe let's start with that. What would you say to maybe counter or address that objection?
Sorry, say that one more time.
With apartments, you can't sleep online, right? Like you have to have a physical place to lay your head at every night. So that's the draw for apartments. I've also heard that apartments are a place for a job to sleep. So if you're investing beyond multifamily, how do you reconcile that?
Yeah, that's a great question. So, remember all those retail apocalypses we were supposed to have? The
Yeah.
Amazon effect, right? Amazon was supposed to put retailers and brick and mortars out of business. Now we have companies like Warby Parker, who started out as an online retailer who's opening 40 brick and mortars this year. Amazon's opening up physical stores as well. You don't have to take my word for it. A lot of your listeners will see the clickbait headlines out there. J.C. Penney survived a world war, the Great Depression, and COVID got him, right? Toys R Us, Bed Bath and Beyond, Sears, Kmart, the big box headlines go on and on. But what you don't ever see is that retail vacancy has been trending lower for the last 20 years. It's been a straight graph line down. And retail vacancy right now is the lowest it's ever been in history. It's at 4%. So retail is by far the healthiest it's ever been in history. And the number of store openings for 2024 are a record high. So retail is the best kept secret in commercial real estate.
Let's play let's play another objection. When you have to re-tenant a commercial space, you've got lots of downtime where you're not generating income. You have potential TI dollars that you've got to spend that you might not have. And of course, there's leasing commissions because you could do it yourself, but there are leasing brokers, my wife, one of them, who that's what they do in the same way I sell apartments.
You've
What
got
do you
all the
do with
good
those?
questions today. Okay, great question. So, anybody starting out investing in retail, you're going to want to start with a mom and pop retail center. Now, think about for your audience, think about where your audience goes for the dog groomer, the pizza place, the deli, the insurance guy, all those neighborhood services, mom and pop businesses, right? typically 800 to 1,500 square feet per store in suburban downtown areas. Those are typically internet resistant and recession resistant businesses. Pizza place, optometrist, dentist, the deli, the meat market. Those are where you want to start. For any of your listeners that want to get involved in real estate, buy stuff that you're comfortable buying, like places that you frequent. And then as you get more experienced, you get bigger and then start buying larger strip malls. And then you're right, there is the real fear of vacancy when you have a big box that had a tenant go dark. It's not easy to backfill that, right? You could be vacant for 6 months, a year, pay up to $500,000 or more in commissions and tenant improvement allowances, but you've got to know what you're doing. You've got to work up to that level. Nobody should start with a 100,000 square foot strip mall.
Unless you have very deep pockets.
Yeah, or have a good partner or somebody that's got more knowledge and experience than you do.
Yeah. So when you're evaluating properties, what are the things that you look for?
Three things: mismarketed, mispriced, or mismanaged deals. Mispriced is the easiest. Residential realtors posting commercial deals, or we will call up when we see for lease listings, we'll call them up and say, hey, we're interested in your building. Tell us more about it. And then we say, look, we want to buy it. We don't want to lease it. And you start the conversation that way. Even commercial brokers, you'll be shocked at how many, not just new commercial brokers, but seasoned second gen commercial brokers misprice commercial properties, right? So,
Hmm.
one, look for mispriced property. Two, mismanaged. Maybe the owner, and similar to multifamily, maybe the owner is out of state, or maybe the owner's got so much money. This is just a property that's the stepchild they don't care about. And mismarketed. We've got a list of commercial brokers who only market on their homemade website, never put deals on LoopNet, Crexi, CoStar. So you want to look where no one else is looking, right? There's a lot of people that will just look on LoopNet or Crexi for commercial deals. How does that make sense? There's already been 1,000 sets of eyes on that property. Unless you get first mover advantage, see the listing as soon as it comes out, and it's mispriced or mismarketed. So you want to look where no one else is looking. Another great one, Stash, is Biz by Sell or Upflip, those business marketing sites, right? People selling businesses. You've probably experienced this. How few business owners know the value of their real estate? Doing a sale lease back, or a lot of times there's listings where the business is for sale, and oh yeah, the real estate's included too. Wait a minute. Do you have any idea how much the real estate's worth? No, it's all included. All right, let's talk.
Hmm. So if you are evaluating a scenario like that, and but the owner wants to retire and sell the business, but you're like, let's do a sale leaseback. How does that work?
You've got a couple options. So what we would do is we would try to find a buyer for the business. Hey, owner, do you know anyone that wants to buy your business? Yeah, my kids, but they don't have any money. Or, yeah, my general manager would be great, but he doesn't have any money. Okay, what if we put a deal together where they make payments to you on the business, but you get to sell the real estate to me and cash out right away? There's a million different scenarios you can put together, right?
I love
Or
that.
most
That's
often,
great.
it's my kids. I want to leave this to my kids, but they're not responsible enough. They're not, their head's not in the game, whatever it is. And you just work out a scenario where mom and dad that are wanting to sell the business, they get paid. And then you take payments either for the business or mom and dad get the payments, but they cash out on the real estate.
Hmm. That's interesting. I love it, by the way. That's value creation. And I think there used to be more of that in multifamily with creative financing and things like that, but it's just become so crowded, you might say, that there's really not opportunity to do that much anymore.
The problem is the playbook has been revealed on multifamily, right? There's so many opportunities to learn that playbook. There's masterminds, courses, books, YouTube videos, and there's a limited amount of creativity you can do in multifamily. And I'm not really knocking it, but what I'll tell you is multifamily, you go in, find something that's built in the 80s, redo the flooring, the lighting, paint the kitchen cabinets, redo the bathrooms, washer dryer, increase rents, rinse and repeat. The problem is you're bound by comps, right? Sorry, there's a boat going by. Is that picking up on the mic? Okay,
No.
good. The problem is you're bound by comp. Stash, if you have a Class B apartment and you're leasing it for $1,500 per apartment per month, and a Class A is down the street at 1,800, you can only raise your rents so much, right? With commercial real estate, when I say commercial, non-residential, you can have a block building next to an abandoned building that you could buy for $200,000. If you sign a 15-year lease with a Dollar General, you just made $1.2 million. And it doesn't matter where you are. It could be in middle of nowhere, rural America. Comps don't matter in our world. And the creativity when it comes to defining a lease, maybe some deferred rent or TI money or a percentage of sales. There's some tenants where we get a percentage of their sales. So there's so many opportunities to be creative.
I've heard about those percentage rents when I was studying, I think for my real estate license or my CCIM designation, but they've been a myth to me. I've never seen them in practice, but I think it's a great idea, especially because it offers, okay, I'll give you a lower rental rate. We get a piece of the upside. And usually you'll be able to find somebody willing to take that deal.
By the way, every sports stadium or airport, all those food vendors are typically percentage rent.
Interesting.
Yeah, you can't
Um,
get into an airport without giving up a percentage of your rent.
I didn't know that. Huh. Have you ever looked at buying an airport?
No, my wife would kill me. No.
You mentioned, I think, Dollar General. So that brings up the topic of triple nets. If you've got a Walgreens that they either opt out of their lease early and pay you a breakup fee, or they just go dark and let it expire and elect to not execute on their options. Like maybe you traded into it through a 1031 and now you're left holding the bag. What do you do there?
Man, that's a really good one. First, not all triple nets are the same. Brokers are notorious for advertising triple net, but you've got to read through every word of every lease because it could be a triple net lease, but landlord is still responsible for maybe roof replacement, HVAC replacement. Tenant is responsible for repairs. So every triple net lease is different unless it says absolute triple net or zero landlord responsibilities. But back to your question, let's take Starbucks, for example. They were the gold standard for triple net leases. They would sign 10-year leases. And once you signed a Starbucks, you just made $2 million. It was everybody wanted to land a Starbucks. Then what they started doing is they started negotiating with landlords and saying, hey, we'll sign a 10-year lease, but in year 5, we have the option to exit. Wait a minute, that's a 5-year lease. When I go to sell this, I'm going to get so much less money because somebody buying this wants 10 years of cash flow, guaranteed cash flow. But now you're telling me there's a risk you'll leave in year 5. You've got to underwrite that as a 5-year lease. In a lot of leases, there's a go dark clause where they have to be open 40 hours per, or, they have to be open during business hours at least. If they go dark, they're penalized. But you're right, it happens. National tenants typically cannot get out of a lease unless the parent company goes bankrupt.
Mhm.
Right now, there's all kinds of variations where grocery stores will say, look, if our sales dip below this amount, we get to pay lesser rent or we get the option of terminating the lease. With commercial leases, you literally have to read every word of every lease, and some of them are 60, 70 pages long. One
Yeah.
paragraph can change the value of this property by over $1 million because of some of those out clauses. So you've got to be very cautious about that. On the opposite end of the spectrum, you have mom and pop tenants, and they might have a personal guarantee. But if their business fails, are you really going to go after somebody and kick them while they're down?
Yeah.
No. With mom and pop businesses, you have to expect them to fail. And for that reason, you can't give them a lot of TI money. The benefit of that stash is I can't tell you how many mom and pop tenants have put 6 figures into our buildings and they've taken SBA loans out for that. They've used their own savings and they put money into your building. They're not savvy enough to know that they can ask for TI, but also they haven't earned the right to ask for TI because there's nothing backing them. If this is the pizza place's seventh or eighth store, they can ask for TI. But if it's their first location, no one's giving them TI.
Right. That's interesting. You're connecting a lot of dots for me that have always just been questions, answering questions for me. So I really appreciate it. Thanks for
I'll talk
allowing
about
me to
this all
grill
day,
you.
man. Let's go.
You mentioned earlier about even seasoned commercial brokers underpricing deals. How does that happen?
I have no idea, but you'll be shocked how often that happens. Now, it's less than 1%. It's not prevalent, but
Sure.
it makes no sense when that happens. We're just baffled. They
Hmm.
missed something, they were lazy. Maybe they had a junior broker or an analyst do some pricing for them. I have no idea, but it happens.
Yeah. Interesting. And so is that just so I want to dig in a little more. Is that just on what the say for lease rate is? And say they're advertising it. I don't even know what market rates are for retail. Is it 18 bucks a foot and they're pricing it at 12? Is that an example?
No, maybe a better example is where the property's listed at gross leases, but you read the leases and they're actually triple net.
Oh,
That's happened. Or a broker, um, you have a strip mall with a mixture of national tenants, mom and pops, and the broker prices it as if it was a mom and pop center. And they don't take into account that the Dollar Tree that has 30,000 square feet really brings the cap rate of the center down a little bit.
but they priced it at a higher cap rate because even though it's almost like they didn't model it in a sophisticated way. And they just said, all right, let's what are your cap rates?
Oh,
That's a good transition.
yeah, we don't really go on cap rate. We go on cash returns. So cap
Love
rates
that
lie.
answer, by the way.
Yeah, well, cap rates lie a lot. Cap rates might be a benchmark. When I train students to look at deals, I tell them never search for 10 caps and above because you'll be shocked at how many listings are advertised at a 6 cap and they're actually a 10 cap or vice versa. But one more example, Stash, about the broker. This was a second generation broker. He's been in the business for 30 plus years. He had a strip mall and they managed it and they were listing it for sale. I knew the guy. I called him. I had never done business with him before, but I knew of him. And I called him and I said, "Hey, would love to make an offer on this strip mall." And he's, "Gosh, we've had so many people like leave us messages wanting to make offers. We just have no time to return calls." I'm like, "Good." So then, as we're in the due diligence, I said, "Hey, these vacant spots here, do you have any prospects?" Same thing. "Ash, we've had so many people call wanting to lease up this space. We just don't have time to return calls." And they're my favorite brokers now, right? I want to stay glued to every deal they find.
Yeah,
So
exactly.
that's,
Because
yeah, I mean, that was a $5 million strip mall that would have gone to a bidding war, sold for probably seven if it hit the market.
really interesting. So, when we're underwriting deals, we're trying to hit 8% year one. Maybe that's over. Maybe you get closer to 10 over the 3 years. What sort of cash on cash metrics are you looking for?
Yeah, so that shocks me because we turn down deals that are 12, 13% cash on cash. And I'll give you an example. So we want value add, right? We want heavy value add. We all have a limited supply of money. We want to grow it as fast as we can. So my partner came to me and said, "Ash, there's a strip mall for sale. It's near where I live. So fly down here and let's try to meet with the developer." Sorry, it wasn't for sale, it was being built. And I said, "Look, there's no money in new construction. It's going to be priced at market." So she's, "I don't care. I want to buy it." I flew down there. We met with the developer and he's like, "Yeah, I'll figure out what the price is if I sell it today." Sure enough, he comes back at market price. And I told my partner, I said, "Look, I told you, nice try, but there's no money in new development, purchasing newly constructed strip malls." So she's, "Okay, give me one more day. I want to look into this." She calls me that night and says, "You're not going to believe this, but there's no renewals in any of these leases." So there was about eight tenants in this strip mall, two buildings, and they all had 5-year triple net leases. The developer did most of the build out, and our initial cash on cash was 12%. And we were going to walk away from that deal because there's no upside. There's a 3% annual increase, and that wasn't enough to get the deal done for us. But when we found out that there's no renewals in year 5, that was a home run because in year 5, these tenants have established themselves in this location. They're already paying well below market rates. The builder put a couple $100,000 in these salons and gyms and boutique stores. If they left, they'd have to start all over. So we're 1 year away from that 5-year mark, and they're paying way below market rent, right?
Hmm.
Now, for your listeners, renewals only help tenants, they don't help landlords. And an example of that is what we just had. If
Renewal
renewal
options already
options,
baked into the lease.
correct.
Yeah.
So if a tenant has a renewal and their renewal is at $15 a foot, but market rate in that area has jumped up to 20, you as the landlord can't go up to them and be like, "Hey, tenant, look, man, you're getting a great deal. We got to bump you up a little. Sorry, I signed this piece of paper that says I have 5 more years at $15 a foot." On the flip side, if their renewal was for $15 a square foot and there's a lot of vacancy in the area and they can get another spot for 10, they're going to come to you and say, "Hey, landlord, guess what? I know my renewal's at 15, but I can move next door for 10. So how about you drop my rate?" That's why renewals only help tenants.
Hmm. I guess that makes a lot of sense. Um, Interesting. I'm just processing what you're
Well,
saying.
Stash, think about your apartment people, right?
Yeah.
Let's say somebody signed a 5-year lease in your apartments. And look, multifamily was on fire the last several years. There were rent increases 10, 12, 15% in some areas. What if somebody signed a 5-year lease for an apartment and they only had 3-year annual escalations? You can't go to them and be like, "Hey, look, everyone else is paying 15% higher than you are. I got to bump you up. Sorry, I got built in renewals."
Hmm. Yeah, but I guess the way to think about what you're doing is different in that with apartments, a 1 year, maybe 18-month lease is standard, but you guys are saying that, and then at the end of that lease, it's, hey, here's your new lease rate. So I think that's the draw or the attraction with apartments. But what you're saying is we'll do a 5-year deal, but no renewal options. And then basically that statement to them is, all right, in 5 years, you're going to have to pay whatever the market is, or you got to go move down the street. And it might just be down the street, but you got to pay new TI, or you got to negotiate new TI costs. You got to move, you got to put moving down the street. There's all this hassle with it. And so the value add is there, right?
Yeah, and your customers are all used to seeing you at this location,
Right.
which is one of the reasons we love investing in medical offices. Imagine a
Yeah.
dentist. If they move, like call another dentist and be like, "Hey, do you want a built-in set of patients?" Because the whole community knows this is a dental office. They're not going to really notice a little name change. They're still going to come there.
Right.
Medical practices, tenants are very sticky.
Hmm. Yeah. And that's a counter to one of one of those objections I brought up earlier. Those medical offices and service providers, you can't get your hair cut online, you can't get your teeth cleaned online. You can't have your There has to be a physical place where your dry cleaning gets done, among other examples. But no, I think that's great. I'm curious about maybe financing. How do you tend to finance these? Because agencies are prevalent in my world.
Yeah, that's where multifamily's got a huge benefit. You guys have a huge secondary market for multifamily loans, right? They can be bought, sold, Fannie and Freddie backs them. With us, it's all local lenders. I just had a call from a lender yesterday, and the guy's, "Yeah, we'll finance value add, but it's going to be double digit." That's okay. That's not going to work. All of our deals get done with local lenders, either local to you or local to the property. Most often local to the property. And in our world, it's all building relationships with lenders. In multifamily, lenders are essentially commodities. You can
Yeah.
get the lowest rate and just shop around, and you guys use lending brokers as well. In our world, we want to do a deal with a bank, and then for the next several years, build a relationship with them and do more and more deals. So our down payment can be lower. So we were anywhere from 15 to 20% on down payments. Now it's 20 to 25% just because lending's changed significantly. But it's still local lenders. The problem we're encountering is lending appetites are changing week by week. So you can't trust a lender because you could be a week away from closing and maybe they have an industrial deal that's going south. All of a sudden, the bank president says, no more industrial, and you're screwed. They're going to pull the loan, right? So when we do a loan now, we have to go in with at least two lenders ready to close. But it's all local lenders. Whichever lender does the deal, it stays on their books for the life of the loan. So they're vested in you and the deal. It's not like residential or multifamily where after a 6 month seasoning, they can sell it and recoup a lot of cash. So our lenders are truly our partners.
Yeah. And then what do their, so oftentimes, and I think this is probably a reason why multifamily prices have become inflated. We'll see full term interest only on loans. Do you, and then, or if even if it's only 2 years, it's then a 30-year amortization, or even HUD is like 35 or 40-year full term amortization, which basically is an IO loan the whole time. What sort of amortizations do you see in
Yeah, with
terms?
us, we get 25-year amortization and we can do an interest only period of 1 or 2 years, but all of our rates are fixed the day we sign the loan. So even the interest only period is a fixed rate. And no matter what the market rates are doing, when the IO period is over, when you hit principal and interest, it's already a fixed rate that you signed when you signed the loan. And our terms are usually 5 or 10 year locks.
Well, that makes a ton of sense given everything we've talked about. If most of your leases are on a 5-year term and they're fixed, it doesn't make any sense to go with a, a variable rate loan unless you're in a declining interest rate environment. But even then, you're still taking the risk that they'll go up.
Our lenders will not do interest only for the life of the loan. So at best, you'll get 1 or 2 years. And that's typically if you're improving the property, trying to fill vacancies. It's not an arbitrary, oh, yeah, you just want more cash flow? Go ahead, interest only for a year or two. You have to have a reason behind it. But here's the other beauty is if rates go lower, just about every one of our loans, if not all, we can just call the bank and say, hey, look, rates are lower. We need to fix our rate. And they'll get on their computer and adjust it lower. There's
Really?
no refinance fees. There's nothing. The only prepayment penalties that some lenders will charge is if you refinance with another lender. If we sell the property, the prepayment doesn't kick in.
Okay. Wow. That's awesome. So I guess that also dictates why you need that higher cash on cash because I guess maybe they're not as related.
No, our cash on cash is after debt service.
Right.
So our calculation's always after debt service. It's not
Interesting.
NOI, it's true cash out, cash in at the end of the year.
Hmm. Interesting.
So I can
Um,
find you a 15% cash on cash deal probably within an hour on a commercial deal. It's not hard, right?
yeah.
But we're looking to add value. So our metrics are if it's fully leased, it's got to be closer to 20. If there's no upside, it has to be closer to 18, 20% cash on cash. If it's a value add, I don't care if there's no cash on cash, as long as we have a demonstrated plan of how we're going to exit this with a lot higher return.
Mhm. It's interesting that you quote 18 to 20% cash on cash because those are the ideal IRRs that we're seeking.
And so our cash on cash numbers are always before sale. We never anticipate appreciation in our pro forma.
Okay.
And unlike most multifamily people, our underwriting, the arrow doesn't go up and to the right. All of our underwriting arrow goes down to the right. We want to stress test deals. We don't, the people that I mentor, I never want to see a pro forma where, oh, hey, if I'm fully leased at market rates, this is what I can make. I tell them to erase it. I want to see how much additional vacancy you can absorb, right? I want to see if you don't get these rates that you think are market rate. What can you still exit the deal with a profit? Like how much pain can this deal take and still break even or better?
And that's wise. Yeah, because a lot of what we see, a lot of the returns are baked in on the sale.
Yeah, we don't do that. But I'll tell you, the 20% came from 2015 to 2019. I invested passively in a lot of multifamily deals, and they were advertising 20% IRR. So I said to myself, look, if I'm going to do the work and put a lot of hours and time into this deal, I better make more than 20% because I can make that passively.
Mhm.
So that's why my benchmark was always 20%. Now, granted, over the last few years, that's come down because it's a lot harder today to find 20% cash on cash returns on day one.
Hmm. Yeah. So you mentioned it a little bit, but you have built a mentorship program. I guess what inspired you to do that, and how did you go about doing that?
I've always mentored people one on one, but during COVID, I had some Facebook acquaintances that asked me if they can jump on a Zoom call and learn about commercial real estate because they were getting killed in multifamily. They had COVID tenants that weren't paying rent. They lived in tenant friendly states where they couldn't evict these tenants. And multifamily had become so competitive that they couldn't find any good deals. So I said, sure. This guy named Isaac Chang out of New York, who I didn't know, I guess we were Facebook friends. He gets him and four of his buddies on a Zoom call. I spent 2 hours and 40 minutes with them, teaching them how to find and underwrite commercial deals. And at the end of the call, they said, hey, how do we keep learning from you? And I said, I'm sorry, I don't have the bandwidth, man. I'm slammed as it is. They just kept insisting, kept pushing. So I asked around to see if anybody else was interested. Next thing you know, we got 20 people, and we started a commercial mastermind. And most of them came from mobile home, multifamily, or single family. And after those 6 months, a lot of them either quit their W 2s or transition from whatever asset class they were in to either medical, industrial, office, retail.
Hmm,
And that's how it started.
that's amazing. Is there a particular deal size or maybe square footage that you guys target when you're looking at new acquisitions?
Yeah, I've got two business partners, and they've constantly told me we're only doing deals $1 million and above. But look, man, I don't care if I find a $200,000 restaurant. If I can make a lot of money, I'm buying it.
Yeah.
So no, I don't care what it is. From 0 to 10 million is I think where the sweet spot is with high returns. When you go over 10 million, you're now into those class A Whole Foods strip malls that will trade at an institutional level. So the returns are significantly lower and the upside is typically not there. They're sold as fully leased triple net strip malls. So that's
Yeah.
where people go to park money.
Yeah, that's what becomes absorbed into like DSTs or things like that. What are some of the, I guess, physical characteristics of properties that when you're evaluating them are either red flags or, oh, hey, that's good news? Is it same as our business, roofs and parking lots, things like that, or are there other things that should be aware of?
The only deal breaker is declining population. It's the only thing you can't outrun. But I've bought buildings, I've bought strip malls, and you know where Owensville is in Ohio, right?
Yeah.
That's a stagnant town. It's never going to grow. It hasn't grown in 50 years. But there was a strip mall that I think it was like a 26% cash on cash return on day one, and it had a vacancy. So I'll do that deal all day long. But I know that whatever I buy it for, I'll probably sell it for just a little bit higher or the same. So it better cash flow a lot higher to make the deal worth it. There's going to be very little appreciation there. And the buyer pool for somebody buying in rural Ohio is going to be somebody local,
Yeah.
right? No one from out of state's going to buy that. It wasn't triple net leases, they're all gross leases. So every deal is different. I don't care about the roof, the parking lot. It all has to make sense, right? You've got to buy it right. Same thing in your world. You
Hmm.
got to buy these things right.
Yeah. You make your money on the front end. And I think that is a universal characteristic.
Yeah.
Interesting. Have you ever thought about getting into development?
We have. So we've developed medical centers, flex space, strip malls, but we don't have a competitive advantage. I can't do it better, faster, cheaper than a real developer. We'll do it if we've got tenants that are lined up or if it's adjacent to one of our properties and we know the demand because we get calls saying, hey, do you have anything for lease? But we're typically not going to spec build retail unless we have tenants or acute market knowledge.
Yeah, I think that's the game in any sort of commercial development is occasionally you can do spec, like in Northern Kentucky, they've been doing spec industrial, but it's because you're next to the airport, which is Amazon's distribution hub.
Yeah, here's a great story. We had a residential realtor who had 79 acres by the airport. And he's like, gosh, what can you do with this? I'm like, I don't know. And this was, I don't know, 3 years ago, 4 years ago. So one of my students is actually, is a friend of mine, but I've known him since he was high school. And he has since become a civil engineer. I called him up and I said, hey, Dan, if you have 79 acres at this address, is there anything you can do with it? And he stops talking. I'll call you back. The next week, he had 4 meetings set up for us with the biggest developers in the world, not the area, the 4 biggest developers in the world. And turns out that was immensely valuable land. And yeah, so we were able to do an option to purchase. And I think it was an $8 million purchase, $12.6 million sale.
Wow.
Residential realtor. And it was a cattle farmer who had this property for generations in his family. And he just thought, you know what? There's these big buildings going up. Why don't we see if we can sell it?
And
And he's like, my number is 8 million. I'm not going a penny below.
right.
And turned out to be a great deal.
And the residential agent was probably a friend of his, and
He was. Yeah.
yeah, go see what you can find.
Yep.
That's fascinating. That sounds like a great deal. What are some of the best deals that you've done?
That's probably the most profitable. There was another residential realtor who posted, it was the Wing Eye Care strip mall in Price Hill on Glenway Avenue. This deal came online Friday night and I saw it. It was advertised as $117,000 NOI triple net, and the asking price was 650. So really, it should have been $1,100,000 at a 10 cap. So that night, man, I went to my office. I didn't sleep all night. I researched the realtor, the tenants, the previous tenants, previous owners, everything I could find about the area in this strip mall. First thing Saturday morning, when it was acceptable to start making phone calls, I tracked this realtor down and I said, hey, is this really triple net? Yes. Cool. Can I put a contract? Have you seen the property? No, but I don't need to see it. Go look at it and then call me back. I drive by it, whatever. It is what it is. And we signed a contract. It was executed Sunday night. Monday morning, this residential broker gets blown up with full price offers. He had cash offers for 800,000 and they're asking 650, right? I actually negotiated from 650 to 625. And Monday morning he calls me, hey, I got a bunch of cash offers for 800,000. So I screwed up here. I'm like, yeah. That's okay. Let's just keep doing more deals together. I'm like, yeah, let's go. I ended up holding that property for 1 year just so I can get capital gains instead of ordinary income. So I made the $117,000 NOI and then I sold it for 1 million. So 625 to 1 million did nothing to it.
That's a great deal.
Yeah. But look, these are out there, right?
Yeah.
Anybody, you can do this, man. When are you going to start looking at some of these commercial deals?
Probably after this conversation, we'll have to have some more conversations. But yeah,
Yeah. And I've trained enough people where this isn't rocket science. It's looking
yeah,
for mispriced, mismarketed, mismanaged deals, and that's it. But it's learning how to underwrite commercial. The hardest part is just knowing all the nuances, and you have to read every lease. So, one strip mall, we have a dozen tenants. Every single lease was drafted by somebody different, and they're all completely different. And you have to read every one of them because, again, one paragraph can change everything.
that's very true. Fascinating. So with the mastermind though, how have you grown that? Because it seems like that's a big part of your business now. Or am
It's
I
not.
wrong? No.
So I never wanted to be one of those gurus where that's all they do is they have these big classes and audiences and conferences. It was supposed to be one and done. I was just going to do these 20 people done. Well, people started finding out about it. After the first season ended, the students are like, hey, like, you said this was going to be 6 months. What happens after the 6 months? I said, I don't know. Let's just keep meeting. A lot of the knowledge comes after you learn the basics because we just kept meeting every Tuesday for 4 hours, and we get to see all the deals that people are working on or the issues that they're having, right? Hey, I'm trying to lease up this office in this small town. What can I do? And we had 20 people giving their opinions, knowledge, and it was a great learning experience for everybody. One of my goals for this mastermind was I wanted to train people, and then when they leveled up beyond me, I get to learn from them, and that's
Mhm.
happening. So long story short, more and more people found out about it, and then our students had friends that wanted to get in. So we did season 2 with 20 people, and I thought that was done. We did season 3, thought that was done. Season 4, we started it, and I said this is definitely going to be the last one because I'm not a mastermind guy. I'm a commercial real estate investor, right? My time needs to be spent looking for deals. So season 4 is about to end. Two of my students are like, hey, why don't we start a course? And I had no desire to do any more education. I was going to keep our 80 people that we've had, and we've continued to meet every Tuesday forever. And we'll keep doing that forever. But more and more people kept asking about the mastermind. So I went back to my students and, okay, you guys still want to do a course? Yes. So it's actually two of my students that work with me to come up with this course. So now it's in course format with weekly coaching calls for me. But
Mhm.
it's the most rewarding thing I've ever done professionally, seeing other people um, change their lives, for lack of a better term. But what I'm teaching them isn't rocket science. Most of it's mindset, right? Joe Fairless and I were on a stage and we talked about the four biggest mistakes we've made in commercial real estate. At the end of his talk, and this guy's got $3 billion of assets under management. At the end of his talk, he said, 20% of my success comes from mechanics, 80% is mindset. And I'm thinking, oh, that's pretty ambitious. I went home and on my mastermind call that night, I asked my students, I'm like, guys, Joe Fairless said this. Do you believe it? And overwhelmingly, people were like, absolutely. Or they're like, it's even 90% mindset. The mechanics isn't difficult. It's really mindset, right? I had a student who was already a commercial real estate investor, and he was going to do one more deal and be done. And the guy was 50 years old. He had young kids, always worked 100-hour weeks in his accounting or his IT business. He's, gosh, I just want one deal, live passively, and be done. I'll get you your one deal, Ken. So as I'm teaching the class, I asked, hey, does everyone here believe if you have the deal, the money will come? Nobody's hands went up in season 1. And I said, okay, it's my job to prove that's not the case. So I said, if that is the case, you don't have the right network. So I got to teach you guys how to grow your network. So Ken pushes back. He's, look, I just want one more deal, blah, blah, blah. Like, I'm not going to market myself. I'm not on social media. I'm a very private guy. And long story short, at the end of that 6 months, Ken had done 3 deals, all of which he raised money for. He's since done 7 or 8 deals, but he now goes to real estate meetups as a guest speaker. Mr. I'm the private person. He's all over social media. So that for him was just mindset. He already had the mechanics, right? He knew what he was doing. He had $10 million of office and industrial. He doesn't need me to teach him how to do retail, but his was just a mindset shift. I was shocked when commercial brokers that were in retail signed up for this mastermind, and I had imposter syndrome because I'm like, what the hell am I going to teach these people? They know more than I do about it, or they should. Well, turns out they didn't.
Yeah,
They know, they're hyper focused on whatever asset or niche they're working on, but they never thought about things from an investor's perspective or from raising capital or improving deals, right? They sold the deal, moved on. They didn't know what happened afterwards. It's been a huge learning experience for me. And again, incredibly rewarding.
that's
And
awesome.
these are
So,
people like we have meetups where there's no conference, there's no course. We literally, our group will go rent a couple Airbnbs and just hang out together on the weekends. So we've built just a great network of people.
So how have you seen or how do you help people shift their mindset?
That's a good question. Most of it is pushing people out of their comfort zone. And I've had students, Ash, you want this deal? I'm tapped out or it's too expensive for me. And I'm like, I'm sorry, what? You're doing this deal. I'm going to help you with it, but it's your deal. You're going to raise money for it. I've never raised money. Cool, let's go. Now's your chance to start. And they get the deal done. And I don't set them up for fail. All of our deals that any of our people do, they bring to our class. And on any given night, we'll have about 40 people on. And it's always unanimous whether, yes, you have to do this deal, or look, there's no way this deal is a loser. Unless you can increase the occupancy and due diligence, you got to walk away. It's comforting knowing that we've got all these experts now that will even tell me, Ash, why are you doing that deal? So it's pushing people out of their comfort zone primarily, whether it's marketing themselves, raising capital, getting partners because the deal is too big for them. We still have people, maybe they've got one or two deals in the works and they'll do the same thing. They'll call my analyst will be like, gosh, Anderson said he's tapped out. He wants to give this deal to you. Call him back, get him on the phone. He's doing it. What do you mean you're tapped out? Do you need to hire an assistant? Do you need to offload some work? So it's me making sure all of these people don't make the same mistakes that I've made over the last 15 years. I never had a mentor. I tried to join every commercial mastermind there is out there, and every one of them are just money grabs.
Yeah.
And I've interviewed students from there. I was desperate. Look, I was so jealous of you people in multifamily. I see you guys level up by going to these masterminds, and it's incredible. So I wanted to be one of those people, and I desperately searched for every commercial mastermind out there, and every one of them was a money grab. Some of them, they just come out and tell you, we train you how to find deals for us. You find the deal, we'll cut you in, or we'll give you a finder's fee. That doesn't help me, man. And
Yeah.
it's also, I don't ever take anybody that doesn't have real estate experience for the mastermind. I want experienced people only. You have to have done some residential. You have to have done something because it's too big of a learning curve if you've never done anything in real estate.
Yeah. You have to have at least gotten your feet wet. Some of those masterminds, in my world, I feel like, it hasn't happened in a while. It's starting to happen a little bit, but not a whole lot. We would get these offers that were identical and from completely different people, parts of the country. And it's, hey, do you know so and so? No, who's that? He gave me the exact same offer as you, almost like down to the presentation. So sometimes I'm skeptical personally as a broker because my partners and I have 5,000 units. You don't have any. You're a bird dog, and I'm not begrudging somebody for trying to improve themselves, change their station in life. Quite the opposite. But just shoot me straight.
Yeah,
Treat me like a professional because I'm going to do my best to treat you like a professional.
yeah, that's a great point because they all have the same playbook. They
Mhm.
all have the same underwriting spreadsheet.
Yeah.
They were all taught by the same mentor. Look, what I tell my students is go into the deal, tell the broker this is your first commercial deal and you've educated yourself, you've worked with a network of people, and you have potential partners lined up. But don't lie and say, oh, yeah, my team and I own 10,000 properties.
Yeah.
Just be honest. Yeah. People want to legitimately help people. If somebody came to you and said, Stash, look, man, I've educated myself. I've spent 2 years underwriting deals. Like, this is my first deal and I need your help. You, based on the seller or whatever, you would either say yes or no. And a lot of times, like, you want to help that person get their first deal.
Yeah,
Yeah, just be
exactly.
honest. Yeah. Stop being a used car salesman. Just be honest.
Yeah, exactly. That's fascinating. What else? I had something else I wanted to
Hey, I got a
ask you
question for
about.
you.
Yeah,
What
let's
do you
roll.
what do you do to market yourself? Because I was at the best ever conference in Salt Lake City, and your name came up more than a couple times.
That's great. I
And
love it.
this is across the country when they talked about multifamily in Cincinnati. Oh, Stash. How does everyone know this guy? So how
Um,
do you get yourself out there?
yeah, I'm a whore on LinkedIn. I have 12,000 connections. But when I first got started, so I'll back way up, and I think this might educate the answer. So I got into real estate because my mom was in real estate. She was a residential agent, and her name was Leslie, and her slogan was "List with Leslie." And I thought that was genius. And unfortunately, she passed when I think I was about 14, 13 or 14, and it was not fun. I figured out that real estate is something I wanted to pursue. And, but I didn't want to drive people around in my minivan on the weekends like she did. And so I figured out that commercial real estate was a thing. I was like, oh, how about that? And when I came here to Cincinnati, I had had the idea of sell with stash. And so I started branding every single one of my emails, sell with stash. And I think we were up to 20,000 people on the distribution list. And then we came to Capstone and you got to clean up a little bit, but we have standards and branding practices here. I was like, that's fine. But I think I still own the website, sellwithstash.com. I think it might still be up. It's out of date, and we talk to a lot of people from across the country all the time. And the other thing is, I, some people are afraid of the phone. I am not. My thought as a broker is if I'm not on the phone or if I'm not having conversations like this, and that's why I started the podcast, because I'm already having conversations like this. I might as well put them on Zoom and push it out. But I just talk to a lot of people. It's funny, my phone lights up starting at 8 a.m. Monday through Friday, but then it's silent on Friday night until Monday morning, which is great.
That's good. And a testament to your character. You love what you do. You gotta
Some
love
days, yeah.
it. Yeah. That's great, man. I love that. And what you said about getting on the phone from our students, every time they find a deal, I'm like, how'd you get that deal? And they're like, I called the broker, or I called the broker on this other listing and he had this one. And it's like, guys and girls, you all need to be on the phone. Call these brokers. Everybody's lazy, including me, where we want to sort through listings online and pick out the ones that we think might deserve a second look. No, pick out the ones that have no price, no picture, no description. Those are the ones that you want to call because the rest of the world is bypassing those. It's not easy. You got to pick up the phone and call the broker. No, I'll just look for the next listing, right?
Yeah.
But that's how you get deals done, man. Look, real estate's still a people business.
Yeah.
You got to call people. Yeah.
And you can't email your way to success, right?
Yes.
I can send out emails now to folks, but it's because I've been hounding them for years. So that's a quick way to hey, I've got a buyer interested in your property. Would you entertain an offer? No. That's okay. But it's because I've been calling these people for years and found my way through the phone tree and finally got directed to the right person I had to talk to. So, yeah, I do what I do. It's a grind, though. Brokerage is
Yeah.
not for everybody.
So what's next for you?
It's a good question. I like everything that you've been talking about today. I've got a couple of things going on in my life. I've got brokerage, obviously, which is my primary engine at this point. I've got a small development deal I'm doing over in Camp Washington, and the stairs were just installed yesterday. Big day. I've never been so excited for stairs because it was just ladders getting up to the third floor, and that was a little dicey. I'm 41. I told my wife when I was 50, I'd like to be making more of our income off of development. So I want to steer my real estate career, maybe in development, maybe we have some more conversations about commercial deals because she's in commercial leasing and sales. And then I have Nedl, which is the software company. And that's if that hits, that'll be like a grand slam, hopefully, is what we're aiming at. But even still with that, the thought would be to invest whatever funds are generated from that in back into real estate.
That's a lot going on.
I
That's a
have a
lot.
busy life and I have teenagers who are
Yeah.
15. So they're good kids though.
Good
Yeah.
for you, man. That's a lot.
Yeah. Yeah. It is. But I feel like if I'm not busy, I feel like I'm just wasting my life. I don't know. It's funny. I got to, so when I first started in the business, I wanted to be the managing director of a national multifamily investment sales shop. And here I am, the managing director of a multifamily investment sales shop. And I got to the top of this mountain, and this is not what I thought it would be. I thought it would, you know, much grander than it is. Okay, we've reached this mountain. Let's go figure out what the next mountain is, and let's go climb that.
Good.
Yeah. Well, this has been great, man. I really appreciate you taking time, and I would like to speak with you more about, and I don't know if my time is right now. Um, Maybe once this development gets online, I'll probably have more bandwidth, but I would love to explore finding a way to work together.
Absolutely. But what I will tell you is a lot of people, when you ask them, why don't you invest in multifamily or why don't you invest in commercial? They're going to say, oh, no, you stick to one thing and hyper focus on it. I think that's the wrong way to look at it. I think you focus on high returns. So, look, if the stock market crashes, we should all just put a ton of money in the market, right? Right now, retail is hot. So that's primarily what we're looking for. But if it comes a time when office is back on fire or multifamily is exploding, pivot and or development, whatever it is, right? The more you know, the easier it is to pivot into whatever's taking off. My advice to your listeners is educate yourself on everything
Yeah.
and go where the returns are. And it's not squirrel syndrome because these market cycles are several years long, right? So I would just continue to be opportunistic.
Yeah, I think you're right. And when we look on large owners' websites, like I had Phil Aftuck from Bernstein Companies on yesterday, and I think I just released it today. If you look on their website, they don't just have multifamily. They're the guys that did textile downtown.
Okay.
They've got hotels, multifamily development, like all sorts of different things. And that's exactly your point. They're a large owner. They started off probably as small, and they've grown practice and a presence focusing on returns and not necessarily just strictly multifamily.
Sorry, outside.
No, you're doing great. If somebody's interested in learning how to invest beyond multifamily and wants to get in touch with you, or if they have a killer deal that was a 20% cash on cash with vacancy to be filled, what's the best way to get in touch with you?
I'll give you my email address. It's Ash, ASH, at Invest Beyond Multifamily or websites Invest Beyond Multifamily. I answer all my LinkedIn messages myself. Easy to find. Facebook, LinkedIn, Ash Patel, Cincinnati.
You're awesome. Ash, I really appreciate
This
your
is a great
time.
conversation. Thank you.
Yeah, no, I hope you didn't feel like I was coming at you in the beginning. I just was genuinely curious.
No, I thought nothing of that. This was a fun conversation.
Good. Have a great Memorial Day weekend, and we'll definitely be in touch.
You as well, brother. Thank you so much.
All right, thanks. Bye.